Welcome to the Explainer. Today, we're going to tackle a part of India's tax system that, let's be honest, can be a real head-scratcher: the reverse charge mechanism, or RCM. In a nutshell, it takes the normal way of paying tax and flips it completely on its head. And trust me, if you're running a business, you absolutely need to know how this works.
Okay, let's just dive right in. Normally, when you buy something, the seller collects the tax from you and then pays it to the government. That's the standard system, called a forward charge. Simple enough, right? But with a reverse charge, well, the rules of the game totally change. The seller is out of the picture, and suddenly, you, the buyer, are the one responsible for paying that tax straight to the government.
So here's how we're going to break it all down today. We'll start with a quick refresher on how taxes usually work. Then we'll get into the nitty-gritty of how RCM flips that responsibility. We'll look at the specific times it applies. I'll give you a simple checklist to stay compliant. And finally, we'll cover the big question: why does this thing even exist in the first place?
All right, first things first, let's make sure we're all on the same page with the standard playbook, what the tax world calls the forward charge.
Yep, it's pretty much exactly what you think it is. You buy something, the seller collects the tax, and they deal with paying the government. It's how almost every transaction you've ever made works. It's the system we all know. Okay, so we've got the normal way locked in. Now, let's get ready to flip the script. What happens when the government decides to turn this entire process upside down? Well, that's where the reverse charge mechanism, or RCM, comes into play. With RCM, the duty to pay the tax literally jumps from the seller over to you, the buyer. The supplier's invoice won't even have GST on it. Instead, you have to do all the work, calculate the tax, pay it, and report it. It's a complete shift of who's liable. So this is probably the most important question for your business, right? When on earth do I have to do this? The good news is it's not random. The reverse charge rule only kicks in under a few very specific circumstances. Okay, here are the main things you need to be watching for. The big one, the one that affects a lot of businesses, is buying from an unregistered supplier. If you're registered for GST and they're not, bingo, that's an RCM transaction. It also pops up when you import services. And finally, there's a specific list of goods and services the government has flagged that always fall under RCM. Let's take a look at those. Now, check out this list. These are services where RCM is mandatory. It doesn't matter one bit if the supplier is registered or not. You'll see things like legal services from a law firm, certain types of transport services, and even fees paid to your company directors. The government has basically decided that in these cases, the tax liability should fall on the buyer, the more organized, registered business. And, it's not just services. Take a look here. Certain goods follow the exact same rule. See a pattern? A lot of them are raw agricultural products, like raw cotton or tobacco leaves. The logic is pretty much the same. It's about shifting the tax burden from, say, an individual farmer who might be unregistered to the registered business that's buying those goods. All right, so you've just identified an RCM transaction. The next big question is, now what? What do you, as the buyer, actually have to do to handle this the right way? Let's walk through the exact steps. Here is your 4-step action plan. First, and this is going to sound a little strange, you have to issue an invoice to yourself. Second, you pay the GST directly to the government. And this is a big one. You have to pay it in cash, not by using any tax credits you have saved up. Third, you report the whole thing in your monthly GST return. And finally, the last crucial step. Once it's paid, you can then claim that same amount back as an input tax credit. So you pay it out, and then you claim it back. That last point brings up a really, really important question that has a direct impact on your company's cash. If you already have a bunch of input tax credits saved up, can't you just use that to pay off this RCM bill? And the answer is a hard no, you can't. This is so important to remember. You have to pay your RCM liability with actual cash first. It means cash has to go out the door. Only after you've made that cash payment can you then claim it back as a credit to use on future taxes. It's a pay first, claim later deal. So after hearing all that, you're probably wondering, why all this hassle? It seems so complicated. What's the big picture here? What's the government trying to achieve with this? It really boils down to one thing: plugging leaks in the tax system. By putting the responsibility on the registered organized buyer, the government makes sure it collects tax on sales from the unorganized sector, sales that might otherwise just slip through the cracks. It's actually a pretty smart way to widen the tax net. So, the real question I want to leave you with is this: is your business truly RCM ready? It's time to take a close look at who you're buying from. Because getting this right isn't just about avoiding some penalties. It's about having control over your cash flow and really understanding the tax system you operate in. The reverse charge might seem tricky, but now you've got the roadmap.